Hi, class. Welcome to week 5. This week, we're going to go through chapter 15, which is auditing IT controls, SOX, and IT governance. Sorry, you can probably tell I have a little bit of cold, but we're going to get through this, right? We're all excited about SOX. So, what's our objectives? We want to be familiar with the structure of a financial audit and the role of the IT audit component. We want to understand the key features of Section 302 and 404 of SOX. We want to understand management and auditor responsibilities under 302 and 404. We want to understand the risks of incompatible functions and how to structure the IT function. It's going at segregation of duties. We want to be familiar with the controls and precautions required to ensure security of an organization's computer facilities. We want to understand the key elements of a disaster recovery plan. And we want to be familiar with benefits, risk, and audit issues related to IT outsourcing. So, like anything else, you can outsource your IT function to an outside vendor, so we want to go over the risk of that. So, overview of auditing. So, everyone knows that each public company gets an external audit to come and perform functions, right? They express, hopefully, an unqualified opinion, meaning that the financial statements are free of material misstatements. And who requires that auditors do this? The SEC requires annual financial audits for public company. We know what CPAs are supposed to do. They go in, they're gathering data, and they're making hopefully an unqualified opinion. If it's qualified, that means something is not too right. We want to make sure that the auditor and the company are independent of each other. We don't want any conflict of interest. The rules are defined by the SEC, FASB, AICPA, and federal law SOX, but SEC has the final authority. PCAOB, and actually SOX comes from the PCAOB, has replaced to a great extent the function served by the FASB and the AICPA. So, what do auditors use? So there are actually standards for auditors. So we've talked before about GAAP, which the general accounting principles. Sorry, my brain is going. Now, generally accepted accounting principles. Now, these are generally accepted accounting standards. So these are the standards that an auditor has to follow to make sure they're doing a quality audit, right? And us as shareholders and companies, that's what we want. So they're the general standards. There's the standards of the field work. I want you guys to kind of read through it, and then what are the reporting standards. There's, what's the structure of an audit? An audit, systematic, logical process with 3 phases. You gotta have the plannings. That's where you're deciding what you're going to test, what you're going to do, what you're going to look at. And then there's the actual test of controls, and there's substantive testing. IT audit involves specialized procedures directed towards clients' technology, which adds another complexity to the audit. If you guys read the article that I provided about COBIT, something to help, because they don't really have specialized guidance on how to perform an IT audit. So if you follow the COBIT standards, that kind of helps. But if you guys get a chance, you can read that. So you can see on this chart what's going in the audit phase, kind of what I talk about, the test of controls, and the actual substantive test. So you're probably wondering what's the difference between a test of controls and the testing and the substantive testing. So in test of controls, you're actually testing internal controls. So if you're testing different controls, like, for example, you put a control in place that, before something gets done, someone else has to review it and authorize it. So you go through, how do you know they've reviewed or authorized it? Well, they normally sign something with their signature. So you go through and you test, hey, did that control, sorry. I'm laughing. I was an auditor, so these are things that we would actually do to, so you're making sure, hey, you say you have controls in place. Does the company actually follow those controls? If it is, and the controls are actually good controls, then you know what? Once you know a company has good controls, you're going to do a substantive testing of like the balances and the GL and all that stuff. But if they have good controls, you're not going to do as much work substanting testing. If you find they have bad internal controls, then you're going to have to do a lot of work to make sure that the financial statements are, as I said, free of material misstatements. So once again, we've already kind of gone over the audit planning, the testing of controls, and the substantive tests. So management will claim their assertions about the financial, what are they stating about the financial statements? Basically, the same thing that we're given a opinion on, that it's free, I'll say the same thing again, of material misstatements. So let's just go through one. So management assertions is going to assert each of these things that, this is an asset that actually exists. So if they say they have cash, there's actually a bank statement that proves that there's cash in the bank. If they say they have inventories, we can actually go to the warehouse and count the inventory. So they have assertions, there's audit objectives, and then you actually have the audit procedure. The substantive test is basically what some of those audit procedures, like doing physical inventory, comparing receiving reports, supplier invoices, purchase orders, journal entries, and I can personally attest that this is exactly what we do as an auditor. So audit risk. So the probability an auditor would render a clean, people get confused with this qualified, unqualified. Just know an unqualified opinion means a clean opinion. They're using my favorite word, free of material misstatements. So let's talk about inherent risk and control risk. Inherent risk is associated with the unique characteristics of the client's business or industry. Control risk is likelihood that control structure is flawed because they're either absent or inadequate, which I've talked about, that's in the test of controls. So we kind of talked about that earlier. And then there's detection risk. The auditors are willing to take the errors not detected or prevented by the control will also go undetected during substantive testing. So auditors use the audit risk components to determine the scope, nature, timing of substantive tests. I've kind of already gave you what we do already. When the audit is complete, you write a report. It's an opinion on the fair presentation of financial statements and an opinion of the quality of the internal controls over the financial reporting. Once again, I said earlier, if a company you find that their internal controls are good, they have a good internal control structure, and they follow their internal controls, chances are higher that there won't be errors. But when there's lax controls, a lot more testing. So this should be an overview of 302 and 404. So SOX establish corporate governance regulations. So 302, that section, you have to certify financial and other information contained in quarterly and annual reports. So this is the financial information. Certify internal controls over financial reporting. State responsible for internal control design and provide reasonable assurance as to reliability of the financial reporting process and disclose any material changes in internal controls. 404 requires management of public companies to assess the effectiveness. So not only are auditors auditing, but you as an internal management have to test your effectiveness of internal controls. And in the report, you have to describe the flow of transactions, including IT, assess the design and the operating effectiveness. This is something that's in your annual report. If you look at the annual report of a public company, this absolutely has to have that. You have to assess the potential for fraud and evaluate controls designed to prevent or detect it. You have to evaluate and conclude on the adequacy of the controls over the financial statement, and you have to evaluate the general controls that correspond to COSO. We've gone over COSO in an earlier chapter. Sorry. So COSO kind of went through this, but it identifies IT controls. So there's application controls related to a specific application, ensure validity, completeness, accuracy of the financial transactions. General controls apply to all systems and address IT governance and infrastructure security, operating system, and etc. SOX dramatically expanded the roles of external auditors. Before SOX, there wasn't much rigor around internal controls. Management didn't have to attest that they had good controls. I'm sure that auditors were testing internal controls, but it wasn't necessarily a requirement, and they weren't testing to the extent that we are today. So here's information technology, the control relationship. Just kind of look at this chart. So, I know we've probably talked about computer fraud or frauds in various other chapters. So, we know computer fraud, theft, misuse, or misappropriation of assets by altering computer readable records and files. Theft, misuse, or misappropriation of assets by altering logic of the computer software. Theft or illegal use of computer readable information. Theft, corruption, illegal copying or intentional destruction of software. Theft, misuse, or misappropriation of computer hardware. Here is a general model for an AIS, accounting information systems. So just take a look at this chart. Computer fraud. So control objective data collection ensure that the event data entered are valid, complete, and free from material error. We'll always say, because at the end of the day, this is leading to financial statements. We want financial statements to be free of material misstatements. So we know collected data generally must be processed to produce information. Data processing fraud falls into two classes. Program fraud, which includes altering programs to allow legal access and or manipulation of data, or destroying programs with a virus. So many viruses out there today, it's amazing. And then there's operation frauds, as the misuse of company resources, such as using the computer for personal business. So database management fraud is altering, deleting, corrupting, destroying, or stealing an organization's data. So information generation is a process of compiling, arranging, formatting, and presenting information to users. Common fraud at this stage is to steal, misdirect, or misuse computer output. Scavenging involves searching the trash for discarded output. Eavesdropping involves listening to output transmission over telecommunications line. So we've kind of talked about this in earlier chapters. I want you to kind of go through the importance of what we say, segregation of duties. Anyhow, certain duties aren't segregated. I mean, much higher risk that fraud can be committed. This is just an organizational structure. This is an alternative organization of systems development. Here we're just talking about a data processing model. We want a corporate IT function to alleviate control problems. We definitely want security around the computer. Sorry.